And in that era, in the 08, 10, 12, 15, etc., people going, what's the role for bonds now? They've got a negative real yield. Are they actually, where do we find yield? And people go around looking for more exotic asset class, going, oh, look at this gives you a 5% yield. And I think in the old days, 5% was risk-free. Now 5%, you've got to sweat it to find 5% yield. So nominal real yields were negative. And when we had the first inflation shock in 21, 22, real yields went structurally negative to such an extent that a government bond was a promise that you were guaranteed to lose money in real terms. You were guaranteed to lose money in real terms. And so that's when we got very, very anxious about the large holding of government bonds because so many investment managers and financial advisors rely on risk profiling tools which set long-term asset allocation that may have no relevance to the current market environment. And although things are in the long run mean reverting, in the short run you can get really slapped around in the face. People were blindly buying bonds and blindly allocating to bonds, even though there was a foreseeable harm event. Interest rates could only go up. They were at 0.1% heading north. Inflation was on the rise post-COVID from the restart. And when you looked at the real yield figures of minus 3% 10-year real yield, it was a government-backed guarantee that you would lose money. And yet people bought them anyway. And so we saw static allocation strategies, what I call sort of dumb portfolios, which usually work in the very long run. They work fine on a multi-year view or 30-year view. But for going into those choppy waters, it was very clear that bonds were actually a hazard. And I'd argue they're becoming a bit of a hazard once again.